What is going on, everyone? Anthony Drew Gary here, host of the How To Show, where we talk about optimizing life, money, and happiness one how to at a time. There's been a lot of talk in the news lately about inflation and prices going up on a lot of the things that we buy on a day-to-day basis. And that logic is appearing to hold true. It appears that inflation is here to stay in terms of prices not going down anytime soon. But I want to take a look at this today in a way of how to rethink the inflationary effects of your emergency fund, because there may be an opportunity here where, based on your situation, you may want to look at your emergency fund in a different way based on the types of things that inflation is currently doing in our world and in our economy. And so, in order to do that, let's check out what we know so far about inflation, what we know about our emergency funds, where we typically store them, and we'll just sort all this out once and for all. I thought it'd be useful to pull up a couple of pages here. And so the first one we're going to talk about is the US inflation calculator, which shows the inflation rates for the last several years. And as we look at these from 2011 to 2021, inflation has been all over the board in terms of the United States year over year numbers. But basically, what we've seen right now in 2021 is the highest level of inflation that we've seen in at least a decade, probably longer. And so what does that practically mean? It means that your dollars are not going to be able to buy as much as they would in prior years. And so basically in 2021's instance, if you've got a dollar, you can expect next year that it'll buy about 93.8 cents worth of things, just because the buying power of that dollar is going down. And so 6.2, maybe it's an anomaly, maybe it's here to stay. In any event, we want to be thinking about this in comparison to what we're doing with our emergency funds, our rainy day funds, maybe the extra cash in our checking accounts, anything like that. If you're saving up for big ticket items several years away, you may want to think about this as well. But the traditional thought here is that we take our money that's our rainy day fund or our emergency fund and we throw it into a savings account. And so we'll go to the first example here and we'll go to the mothership. We'll go to Chase. And right now, their savings account interest rates are impressive. They are giving you 0.01% interest per year annual percentage yield. And so to break that down, what that really means is per every $1,000 that you have in a savings account at Chase, they are giving you 10 cents of interest for every $1,000. That's awful. Unfortunately, that's the way that we are in the interest rate environment right now. There are pros and cons to that. The pro being you can get a really cheap mortgage. The con being if you've got a savings account, you're getting next to nothing on it. So let's compare that. We'll go to a different option. And so we'll check out Marcus by Goldman Sachs. This is what they call a high yield savings account, which is kind of funny because it's still not really all that good. This is offering 0.5% APY. And so for every $1,000 you have in one of these types of accounts, every year you will make $5 on it. Relatively speaking, this is still nothing compared to either option. Stuffing it under the mattress doesn't get you a whole lot less than these options based on the numbers that we're looking at. So realistically, we are comparing that to inflation. So 0.01 or even 0.5 in every single year shown on this graph from 2011 to 2021 does not beat inflation. And so theoretically, if you're keeping extra money in one of these accounts year over year, you're losing money by doing it because the purchasing power of it the following year is going down. And I say this, if this is a situation you find yourselves in, you are not alone. I was in this situation myself for years and years and years. I'm not proud of it, but I wasted a lot of time in a Chase savings account when it could have been somewhere else. And so if you start to think about this, if using a Chase savings account this year is going to cost you 6.2%, then theoretically, maybe it makes sense to look at some options that involve stocks or mutual funds. And so I know there's a lot of risk associated with stocks. The stock market is risky. I could lose all my money. Yeah, that's possible. But let's look at a couple of examples while we do that. So famous companies traded as penny stocks. And what this means is these are basically companies that went from a really high value all the way down to nothing. The examples are BlackBerry, Ford, Pier 1, Fannie Mae, Freddie Mac, Sirius. If you were to put your emergency fund into one of these companies, yes, that's very risky because any one stock could go down really quickly over time. And you don't want to find yourself in a situation where you've put all your eggs in one stock basket. Your emergency fund is tied to the performance of one specific company. It's just too risky. Thankfully, there are other ways to do this. And I talk about this a little bit in other videos, but basically, there are mutual funds that match indices. And so you can look at different mutual funds that match, let's say, the S&P 500, for example. And so this is what I pulled up here. And over time, the S&P 500 statistically grows more often than it decreases. And so if you start to think of this, this is a website that you can check out. This is off of Macro Trends. Year over year, the S&P 500 is typically growing at a rate. And for the handful of years where it's decreasing, that's considered a statistical anomaly. As you can see, there are a lot more green than there are red on this chart as I scroll down it. And so it's worth thinking about, if, let's say it this way, if inflation is 6% and Chase is giving you basically nothing, that means you are losing 6% by investing with Chase. So over the last handful of years, this one, 2018, it was down 6.24. 2015, it was down. You have to go all the way back to 2008, which is a really significant time in the United States economy, to find a year where the S&P went down more than the inflation rate, basically. So a different way to think about this, what if you invested some of your emergency fund? Theoretically, it could go down, yes, but it's not going to go down to nothing. And I can say that with confidence because if the S&P 500 went down to nothing, it would basically mean the collapse of the entire United States economy as we know it. And at that point, you basically had no benefit to having money at all. You'd be better off storing food, guns, ammo, things like that, because the world as you know it would not be in existence. So we can feel pretty good about the fact that as long as the United States of America exists, the S&P 500 will not go to zero. And so maybe it makes sense if some of your portfolio goes in that direction. I know that that's something that my family's been looking at a little bit over time. And I can tell you that it's done, better than we would have done if we were in just a savings account. And so past performance doesn't always mean future success. But in this instance, we are talking about a situation where there is a good chance that it may be worth looking into, and a really good chance that you will not lose all your money by throwing it into an index fund that matches the S&P or some other large index. So looking at this in different options, if you've got a savings account that's sitting there making a penny or two in interest every year, maybe there's a better place to put that. And so I challenge you to think about that. Maybe it makes sense to make a move, and you can do that in a number of different ways, really. There are a lot of brokerage options that are done from your phone, from the internet. You don't necessarily need someone's help to buy an index fund that matches the index. You can just go out and do it. And so this is an opportunity for you to empower yourselves and empower your money that you've got sitting on the sidelines while you don't need it immediately. That's going to bring this episode of the show to a close. Hopefully you can take something away from this, make it beneficial in your life, and maybe you can share it with somebody else and make it beneficial in theirs as well. If you like the content that we're producing each and every Wednesday, you can subscribe to the channel. You can hit the like button to know to let YouTube show this video to other folks as well. And you can check out the podcast by searching the How To Show on the podcast player of your choice. If you have any feedback or any topics for future episodes on the show, hit the comments down below and let me know what you think. And if you are interested in buying or selling a house in the Indianapolis market, please reach out to me either in the comments or you can reach out at indiedwell.com. Link is in the show notes as always. Until next time, this is Anthony Drew Gary, host of The How To Show, signing off.